it's somebody who says, well, I don't need to see this money for 5 years, 10 years. And by the way, if it's underwritten for, let's say, 3 to 5 years for an exit, I'm still going to say, do you need this money in the next 10 years? Because especially in the latest real estate environment, things change. Like, targets are different than reality sometimes.
Welcome back, everybody, to the CashFlow podcast, the podcast where we talk about turning properties into profits. I'm your host, Jason Yoss. And before we get started with my special guest today, I want to go ahead and thank our sponsors, Daniels Plumbing, servicing plumbing and HVAC all throughout San Diego County, Riverside County, and Orange County, as well as Rainforest Plumbing and Air, servicing all of Maricopa County. That's your greater Phoenix Metro. Without them, this show wouldn't be possible. Thank you, guys. And now, to my guest. Today, I'm here with Justin Freisted. Justin, nice to meet you.
Hey, it's great to be here.
Hey, man, I'm so excited after talking with you on the phone and then having you in person. I've learned so much in just one phone call about what it's like to raise capital. All right, but now I want you to kind of give me the deep dive so our listeners can also get that feel of like what it is to raise all that money. Have you been doing this forever? Like, how'd you get into this space?
It's pretty new. I kind of got into it through, I would call, forced innovation.
Right.
You know, I did direct sales for a decade, had an in-home food delivery service with my dad. We ended up selling that in the pandemic because the whole world was in the market for food delivery. So it was very unexpected.
Right.
Company exploded, and when private equity wants to buy you at a valuation you probably won't see again, you got to make the move. So it was kind of a panic, and I didn't really know what I was going to do with the rest of my life. I had been investing heavily in private placements as a limited partner. So I was pretty familiar with the space. I knew I wanted to be there, but it was more so as a sales guy, it was looking at, okay, in this direct sale, you could really max out the vehicle here. Like, what's the ultimate vehicle that I could put this skill set into use and, just get more juice for the squeeze? And there's really no higher ticket sale than raising money.
I love the fact that you talk about how that ultimate sales gig, raising money. What firms are you currently working with now to go ahead and maximize that opportunity?
Yeah, so we've got a private equity real estate fund. It's called Pitch Equity Fund. That's the main fund on the private side. I'm also on the board as the capital advisory chair at Safe Space Global. That's publicly traded. We did do a private round, raised $10 million into the company back in January this year. So done some raising on the private side and the public side, and it's very different. And it's all just so exciting and so much fun.
Before we get into that room and have you walk through what it's like to go there, I want to talk to you a little bit about like philosophy. Like, what is your overall philosophy in the raising money space?
Philosophy-wise, man, that's a lot to unpack. I think the philosophy for me is giving institutional access to the everyday accredited investor. There's not a lot of that going on. It's a very protected class of people who get to invest in the best deals in the world. So I kind of looked at, okay, because I'm new in the space. I'm not a guy that has an MBA from Wharton. I didn't intern at Goldman Sachs. I don't even have a degree, right? which was a very limited mindset I had about getting into the industry until I met a guy that was a $1 billion fund manager who had no degree, and then limited belief shattered. So I think that's something for the average investor to realize is that they can get into this space too.
Right. And that's huge. Talk to me about mentorship then. You were saying, hey, there's limiting beliefs that you had because of maybe some of your background, and now you meet up with somebody who said, nah, you can do this. So talk to me about the mentors that you've had as you transitioned into the space.
Yeah, it really came out of just being willing to show up in rooms. I didn't do that for a long time. Didn't network at all. Kind of had my head down, building the business, staying in the lane, which regardless of what you do, it's a huge mistake to do that in terms of everything's a people game. Your next opportunity is a person. It's always a person, that's either doing a transaction with you, that's introducing you to someone who's a good mutual benefit. So I kind of got forced into that. And, I just went to all these masterminds, went to all these events, buying the highest price tickets so I could meet the speakers. And, that's how I got into everything that I'm doing now. I met my partners at an event. Building the personal brand, all of those things, I was listening to Brad Lee's podcast religiously for years back in 2018, 2019, just getting the wheels turning. And I think that's a concept about mentorship is in the beginning, you don't have the capital. No one does to actually get into proximity of these big figures, right? It might be 50 grand if you want to get coached one-on-one, 250, right?
Yeah.
So you've got to realize that rule of 5 is the 5 people that are closest to you. It's not a physical thing. It's what you're putting into your head. So in those early days when I was pounding those podcasts and reading all these books, like my mentors, the 5 people I spent the most time with, they didn't even know I was spending the time with them. Right. So until you can get to a level where you're actually in the room with these mentors, you got to do it vicariously.
Well, and talk to me about that. Like, somebody like Scott Boroff, who is the CEO over there. How did you connect with him?
So that came out of personal brand. Right, they're looking at me. They're looking for who do we want to be the capital raiser and our head of investor relations, because his public company that started in 2016, he funded the whole thing. The company has no debt. They don't need any money.
Wow.
And the only reason why we did this capital raise was to put enough cash on the balance sheet to check a box to uplist on the New York Stock Exchange. You got to have a certain amount of burn rate. Huge. So imagine having to raise money that you don't even need. Which is very interesting. But he flew out to Vegas with Coach Michael Burt. They came to met with me, and and now did that, and we've got our private equity fund together. So none of it happens without building your personal brand. Like I will harp on that till the end of time. Every single door has opened because of that personal brand.
And before I get into talk about raising capital, we talked about this a little before the show. Let's talk about social media and utilizing or leveraging that to raise your personal brand. Give me some, and our listeners some, feedback, some nuggets on that.
You got to meet people, right?
Yeah.
People think that building a personal brand is spamming the platform with your content.
Sure.
Like that's like standing on the side of the road with a billboard saying like what you do. Like, are any cars going to stop? Is anybody going to talk to you? Probably not.
Sure.
So I think sending DMs and starting conversations with the people you want to work with, DMing podcasts, get into platforms like this where, new audiences can see you and then send you messages. And, I probably have 50 conversations a day in the back of my Instagram having nothing to do with what my managers are doing back there too. I think people really forget that this is just a people game, but you're building your following. There's all these strategies to build a brand, the content, the editing, all of that stuff adds up to this business card, let's say, that allows you to even get an answer when you send a DM to someone who's higher up in the food chain than you. This is a food chain concept. Like if I want to get somebody of value to answer, I have to look like someone of value.
Game attracts game.
That's it.
I'm so glad you went into that because people are still using, in the business world, social media like a dating platform. And it might be great for that, but that's not what we're trying to get accomplished. So appreciate that insight. I want to kind of shift over and talk about raising capital because especially in my space, I see developers talk about, hey, we're going to raise capital all the time. What does that mean? So give me the big blue arrow for our audience. What does raising capital mean? And then go a little more into like at your level, what does raising capital look like?
At a basic level, raising capital is I don't have the money, or maybe I do have the money and it's better risk allocated to use someone else's money. It's very interesting because I've met wildly successful 9-figure guys that did it both ways. Some of them did it with none of other people's money. They like to roll their own capital. They like to be all in on the thing. Others look at it as that's too much risk. Right. I want to bring in outside capital and I take a smaller amount of the win, but you can also get more leverage that way.
Sure.
So there's usually, especially in real estate, you're going to have a debt and an equity side of the deal. Right. Like if I want to buy a 10, 20, $30 million apartment complex, probably going to have to put 25% or more down. That's the equity you need to raise. Right? So that you got to go out and find people that want to give you that capital, and then you can borrow the rest from a bank. So that's essentially what capital raising is. And then there's all these different sectors of how you structure a fund, which is essentially just an entity. It's just a business that accepts different types of capital compliantly.
What's I know you told me this before, but what's kind of a minimum target that you will typically go after? Are we saying like, hey, somebody who's got $5,000 or they have to have $5 million? Like, what is your focus point when you are raising capital?
So generally speaking, we only raise capital from accredited investors.
Accredited investor. And just real quick, accredited investor is?
So you can qualify by income or by net worth. If it's by net worth, it's $1 million net worth, excluding your primary residence. You can't use that equity in your net worth equation. If it's by income, if you file your taxes single, it's got to be $200,000 gross in the previous 2 years with the expectation in the current calendar year.
Yep.
If you're filing married, it's 300,000.
So you obviously got it down on what an accredited investor is. And so when you're focused on that, talk to me a little bit about like how you're able to leverage that money from a prospective investor. Like, do you got to get in a room? Do you got to get in a lot of rooms? What does that look like?
It's a lot of different things. It's a multi-faceted approach, let's say. It's your warm network first, people that have previously done business with you, friends, family. Like, you've got to be able to, if you really believe in what you're doing, you got to, a lot of people have just money issues mentally and they could never ask someone, for money, but do you really believe in your deal, right? Does this person understand the risk they're taking, right? So to me, the fiduciary responsibility is giving someone the opportunity to make the investment, but also them fully understanding the risks they're taking, because things do go bad in investing. Like,
Sure.
That's the whole point.
And we're going
right?
to talk about that too, that things do go bad.
Yeah.
What is the expectation that on their part in terms of, okay, I'm giving you 100,000, 500,000, Justin. Okay, what are they expecting you return back to them? And how does that normally look?
Million different ways to chop this up, right? So if you come into our debt fund, you're going to start getting monthly cash flow that's fixed, right? So somebody that wants income that's stable and predictable, you're going to go into a debt product, right? That's why we've structured the funds this way. We might even deploy the capital into the same deal, equity and from the debt fund, but the investor gets paid in a completely different way. If it's somebody who says, well, I don't need to see this money for 5 years, 10 years. And by the way, if it's underwritten for, let's say, 3 to 5 years for an exit, I'm still going to say, do you need this money in the next 10 years? Because especially in the latest real estate environment, things change. Like, targets are different than reality sometimes. So I'm going to be super conservative, ask those questions, because usually on the equity side, you're going to get a bigger exit and your internal rate of return is going to be higher than if you were on the debt side. But you're probably not getting any distributions.
Yeah.
That capital's got to sit there. So it's really just an equation of, do you need this capital? Do you need monthly income? And then figuring out what's the right product for that person to go into.
And lastly, when it comes to expected return, obviously you tell people like, look, if you want 1%, go put it in a CD for a year. But what are you telling them if you want big returns? When you say that, what exactly are we talking about return-wise? Are they getting 5%? Are they getting 10%? Like, what are they getting for putting up that kind of money?
On the debt side, you're going to get 1% a month.
Okay.
So 12% a year, paid monthly. We do it on a 5-year structured note. So we're going to hold that capital for 5 years. At the end of it, we're going to give you your principal back plus a 24% kicker. So when you IRR that, they're getting 16.34% fixed. And just something for investors to know, when you're on the debt side, you're first to get paid. So the equity investors, like if the deal isn't doing so well, that debt's getting paid before the equity guys get anything. So it's actually less risky than being on the equity side of a deal. Now, if you come in on the equity side, every deal is going to have a different target. And we're super conservative. Like we're doing a small project right now. It's called Lions View Estates. It's 4.5 acres right next to the Cherokee Country Club. It's got a 5-year wait list. Like the exit, we already have everything underwritten very conservatively, and we're telling people it's a 1 to 2 year hold,
right?
Just a horizontal land development, and then we're flipping these lots to the builders. We're saying 25 to 50% is the net return on this, and that's super conservative. So we always want to say less and do more.
And that's a great philosophy. What is it? Under promise and over deliver, all the way across the board. Let's talk about that development, that current case study. Okay, how did you guys find this? Where is it? And what's the plan?
So that one's in Knoxville.
Okay.
Scott Boroff, him and another partner own the land free and clear, which is another competitive advantage. A lot of these syndicators, people that are, they get a deal under contract and now they're in a race to raise the capital to get the deal closed. Right. When you're dealing with more seasoned investors, someone like Scott that's done $1 billion on Wall Street before going privately, he knows how to be in a position of power where we don't have to negotiate. We always have the leverage. So we already own the land free and clear. We're already starting the horizontal development. We're bringing in more cash. That's what we're investing to finish a road, a couple other things, and then we're going to sell the lots. So that's a very simple project.
What is the end state on that project? What type of product are we putting over there? Is it multifamily? Is it retail? Is it all of the above?
These are single-family homes.
Really?
Yep. So it's the last piece of undeveloped waterfront on the Tennessee River there, right next to, I believe it's Tennessee River, right next to the Cherokee Country Club. So the house that's being built adjacent to our 4 lots is a $20 million house.
Wow.
Right? and there's no other houses there. So we got these 4 lots. We're putting $4 to $5 million houses on it. The demand is already there. Those homes will probably be sold before, they even go ground up on it.
And is the plan for you guys to do it all the way from A to Z, or once the lots are developed, then sell them off one at a time, 2 at a time?
Yeah, we'll do it in tranches. So these investors are just invested in the horizontal development.
Got it.
Road, sewer, gas, water, all that. And then once they're parceled, ready to go, we're going to sell them to the builders. And that's, as the lots are sold, that capital gets returned to the investors. And then we say to them, hey, do you want to invest in the ground up with the builder? Right. And we'll do that in a second phase.
Love that.
Yeah.
Love that. And I see some of the same infill development projects here in San Diego as well as in Phoenix as well. Phoenix, I see a little more multifamily. In San Diego, I see a lot of single family as well. They got enough room to put, 8 houses. They put them up and then they sell them off. So it's fantastic that you're able to do it both at a grand scale as well as you can do this at a smaller scale. Let's talk about, that's an amazing deal. But you alluded to earlier that you've had some that aren't perfect.
Yeah.
A little hair on them and maybe bad outcomes. Talk to me about that. What's the possibility of a deal going bad?
I think that's what makes investing so fun, but also stressful, is that, no one's got a crystal ball in these things. I don't think, many people predicted how aggressively rates would go up from, 22, 23 into 24. Insurance costs went crazy.
Oh.
You had all of these headwinds in real estate. And then, we made the mistake of buying a bad deal in right outside Atlanta. And when I say we, that this was before, like, I'm not a GP on that fund. I made a bad decision deploying my LP money into someone else's deal. What I didn't factor into the due diligence was the court system there, the types of people that were there, and when inflation went crazy and that, look, let's face it, that really hurts the lower end consumer.
Sure.
All of a sudden, all these people aren't paying their rents, and we can't even get through the court system. 6 months of people not paying, there's no evictions, and our NOI is going negative. And now all of a sudden, the properties like that are valued based off your net operating income. Like, that is the multiple of the valuation. So all of a sudden, your property's valued at half of what you bought it for. And it's a very interesting environment because we're digging our way out of that deal. I think we can save it. But if we can get to a break even in the next few years and then get rid of it, I think that'd be a huge win. So, sometimes, and again, you're looking at slide decks and targets and demographics and all these things that early in your investing journey as a limited partner, you think that's really like gospel. But there's just black swan events that just come out of nowhere that completely change the game.
Absolutely. I think you're 100% right. Black swan events, things that we couldn't see or didn't see unless we've been through it before, those things come up. And I push the same thing here. Look, I do business in Arizona, Nevada, California. The landlord-tenant law in California is such that if you get stuck with a property, the court system is so slow that if the property is not performing because the tenants aren't paying rent, for whatever the reason, it can be 6 months plus before you get them out. And as you said, if their rents aren't coming in, NOI goes down, and what looked great on those pretty slide decks is no longer real life. So I totally understand where you're coming from. What else? You've got to have some experience. You got to have some more of these. Again, you have so many wins. I just want people to see, like, sometimes it doesn't go perfect, and this one is an example of okay, we held it, but do you have any others?
Yeah, we have a private equity fund with some other partners that's late stage, meaning we invest in companies that are already $1 billion plus unicorns that are private going public in the next 2 to 4 years typically. We had the opportunity to raise for SpaceX and Flexport. Wow. And this is through a fund-to-fund model, right? So qualified purchaser is $5 million or more, right? So the big firms don't mess with anybody except qualified purchasers. So We'll go raise from accredited investors at $100,000, $200,000, like $500K. Some of them put $1 million in, and then like once we've got $5 million, now we can go in as a qualified purchaser, fund to fund, one SPV removed from the cap table of the Palantirs of the world. Yeah. So the firm that we go fund to fund with, somewhere around $6 billion under management. And they were pre-IPO on Lyft, Spotify, Uber, Airbnb. Like when everything was going great, we raised into Flexport, and we got those shares at $7, which we thought was a fantastic price because Andreessen Horowitz put in $1 billion at 14 previously to us coming in later. We're catching a falling knife. Well, the company's just been sputtering. it's looking like it's gonna reignite and get to IPO, but it was supposed to be a 12 to 18 month time frame, and that was in 23. And here we are, the company's still not ready for IPO. So again, it's like, it's not that it's a bad deal. I think it's still going to work out, but complications, the timeline, the goalpost just keeps moving. And this is just what happens in investing.
And how is it hard? Do you have to be risk averse, or do you have to be comfortable with risk? And where do you have to be able to sleep at night when you're investing in this manner?
Yeah, you definitely have to have a thick skin, for sure. But I think what tames the stress is good asset allocation and risk management, right? Like if I have $1 million to invest, and the minimum on most private placements are going to be 100,000, okay, right? It's like, oh, I really love this deal, I'm going to put 500 in it. No, I'm going to put 100 in it. Just as much as the one I don't love as much, I'm going to put 100 in that one, because I need to be emotionally agnostic to the reality that what looks great could be completely different. And I learned this with my first round of multifamily apartment investing. The one I put the least in ended up being the best deal because the environment shifted, right? So that one, we doubled our money in a year and a half, and I was out of the deal. And now I've got an infinite return on the cash flow of that property. Sweet. Well, this one over here in Atlanta is like dying, right? But it's overall not so stressful because you take that $1 million and you put it across 10 investments, right, instead of getting emotionally involved in the one you like. So that's just the way I looked at it. And I don't get too concentrated in one part of the country or with one operator or with one partner. Like that's how you spread it out, because things will go bad. And when it happens, you just want to make sure it's a small dilution of the bigger picture.
And that makes a lot of sense. You have a ton of experience now in a short time. Let's talk about some of the lessons learned. Some of the hey, okay, I would definitely do this. I'm going to recommend you try to do this. Let's go through some of those for our people who are, maybe not as experienced in raising capital or deploying their own capital.
Yeah. So if there's one nugget that everybody takes away from this that can save you millions of dollars, would have saved me a bunch of money on one thing. It's called third-party reporting.
Okay.
Huge, because what typically happens in private placements, it's a person. It's usually not the deal, right? Like I was in one syndication as a limited partner. There was distress elsewhere in that portfolio, and the GP moved money from that bank account to go try to save another deal.
Really?
Right? That's wire fraud, right?
Yeah. Now,
if you have third-party reporting in place, it means that the fund banking, the general partner, and the third-party admin, all three have to sign off on any money moving, on any transactions. The third-party admin's doing the statements, they're doing the accounting, they're basically a checks and balances system.
Sure.
It protects the limited partners, and it protects the general partner from himself.
From them doing anything that maybe they shouldn't be doing. Tempted, but yeah.
Right. So any fund that I've had has third-party reporting. It's the number one question I would ask for anybody that's looking to invest in a fund is, who does your third-party reporting? And then go look into the credibility of that. And at least you can protect yourself from fraud.
I love it. I love it. As we come to the end here, and I know that's a great one, is there any specific areas that you're very bullish on deploying capital or raising money in the real estate sector at all?
Yeah. What I've learned working with Scott is that access is everything.
Got it.
The harder it is to get into the deal, the greater the opportunity, and the more accessible something is, the more diluted it is. It's like anybody can go on Fidelity and invest in a REIT. You get 4%. You don't even get a K1. You don't even get the tax benefits and the depreciation of what that trust holds, right?
Right.
So you get closer to the deal. You get more and more upside, and there are no good asset classes. There are no bad asset classes. There are only good deals and bad deals.
Only good deals.
And that's what I've learned with Scott is, he's looking at 100. He's got connections in New York with banks, and he can buy off market things out of bankruptcy. I mean, the deal that we just closed on last month, we finished that raise a couple of weeks is all it took. It was just a steal. It was in Chattanooga, 120 acres of waterfront development, over $100 million in tax incremental financing from the state of Tennessee. So when you're able to get the taxpayers to fund your development, and you're buying the deal at 80% off of the CBRE appraisal, I mean that's a deal that's near impossible
You
to
made
fail.
money at the close of escrow. You made money before you even started it.
A limited partner that put in $100K, their equity was worth $577,000 on day one.
It's crazy. I love to hear those positives. What's the biggest challenge you're seeing in the space right now?
The biggest challenge by far is the LP environment. Everyone's terrified. 2020 to 2022 was the just gangbusters golden age of capital raising.
Right.
It was so easy for somebody to go get a HELOC on their house at 2% and then invest it for 8 to 12. It was, you could just borrow your way to returns.
Sure.
That's completely changed. A lot of novice investors did put capital to work during that period into real estate syndications. They were super hot, and almost all those deals are struggling if they haven't already lost their keys to the bank.
Yeah.
So you have a huge cohort of people that tried their first private placement investments, and they're in the mindset of, I'll never do that again. Right. So it's a lot of fear out there right now, which is obviously, as a seasoned investor, that's the indicator, like, now is the time to start buying those deals from the people who made those mistakes.
Right.
And if you're somebody who made that mistake, which I'm one of them, I deployed capital that I'm probably going to lose during that period of time. Great. That's, you write off the losses and you keep your wins and you keep going.
Yeah, absolutely, 100%. I'm after 20 years being in the space, I've got losses too, and I learn from them. That's what I learn from them, and but I keep going out there, and that's how I've been able to grow a portfolio. Let's wrap up with this one, and I love this, especially someone who's worn a couple hats in some ginormous spaces now. Last piece of advice. If you were to get in the DeLorean and go back to baby Justin, what are you telling yourself? Hey, start here, do this. What are you saying?
I think it's pretty simple. I would just tell myself, fail harder, fail faster. Like, none of this means anything. I can't remember who said it. I love this quote. It was like, 0 to 40 is just research, and then life starts. And I'm like, man, that really hits, right? So, at every stage mentally, you're trying to protect something that you don't even want. Like, you want something more. So stop being in the mindset of what you have is something worth protecting. You need to bet it again. Keep going to 0, keep failing, keep losing, and that's what qualifies you to get the one big win. You only have to be right once.
Right.
So that's what I would tell myself.
0 to 40, you're just experimenting? Is that
It's
what
just
it is?
research.
Just research?
Yeah.
I'm going to borrow that one. That's a great quote. 100%, I'm behind that one. Justin, really appreciate you coming in, giving us a breakdown. I know there's a lot of people out there who are always, they hear it. Okay, I want to raise money. I want to make the big deal. I want to do the big development, but they didn't understand until you came in and gave us some nuggets. So appreciate your time. Thank you so much, everybody. Justin Freistadt, thank you so much for coming in and joining us. Appreciate it.
My pleasure.
Everybody else, thanks for tuning into CashFlow, the podcast where we talk about turning properties into profits. We'll catch you next time.